Okay, I've got the top of the hour here. I'm just going to kind of, as I typically do, I kind of do a slower introduction just to let more people come on in. But want to thank you for coming on board today. This is our webinar about more or less how short-term care fits into this, I don't know, extended care market, long-term care hybrids, life and long-term care plans. Talk a little bit about, the origins of it, really a shifting market that we're seeing out here over the past, I don't know, decade, I suppose. Kind of where short-term care has really kind of grown, where it's come from, the reason for that. And then we're going to try and do some comparisons. I'm going to show you how these short-term care plans can compare to, say, the long-term care traditional and or a hybrid, life and long-term care hybrid. And in many ways, and you'll kind of find this out at the end of the webinar, I can make a great argument for presenting short-term care. It's been kind of this product, and I'm guilty of it. I'm kind of using short-term care as someone who can't get long-term care. I've used it for my long-term care declines, or I've just thought, it's this less of a product. But after having marketed this now hard for the last year, it's really opened my eyes. Again, just a little about myself. My name is Jeff Clark. I'm a regional director here with GoldenCare. I've been with GoldenCare for 26 years. I started selling long-term care. I've written over 750 long-term care policies, short-term care policies. My job now, I was in the field from 96 to 2001, selling exclusively, but 2001 I shifted to more of a regional director role, where my job now is to kind of help agents learn products, help agents write the products, educating, doing seminars, teaching, training agents how to do it. My job typically is comparing and contrasting all the different plans, giving our brokers, agents out there some good options when they bring us cases, whether it's a married couple or a single woman with osteoporosis. GoldenCare has a full queue of products that no matter what you bring us, whether again they're healthy, super healthy, if they have a small budget, large budget, we have all the products in this extended care market to help you kind of find the right product. And that's kind of what I've been doing. So again, my name is Jeff Clark. I've been with GoldenCare for 26 years. So, and again, just going back to what I was saying, the short-term care has really been a burgeoning market. And so let's go ahead and get rolling. I'm going to open it up to questions. You can type your questions in. So what I'm going to do is I think I got about a half hour here, maybe 35 minutes. And then I'll just go ahead and bring the questions up, and I'll try to verbally kind of repeat them and see if I can answer them that way. And certainly you can give us a call at the office here. That number will come up later, 800-842-7799. Also, you'll see our agent website there, goldencareagent.com. There you can find all the pre-recording trainings of this and many other topics we do on short-term care, long-term care, all of our products, all of our selling techniques, all that kind of stuff. So great agent tools, goldencareagent.com, or certainly call us here at the office, 800-842-7799. All right, let's go into presentation mode. All right, I've been assured that people can hear and see my screen. Let me just verify that with Corey. Ooh, and someone else wants to show you quotes. Okay, we'll come back. All right, I'm not getting any pushback as far as being able to hear or see me, so we're going to get rolling. So again, today we're going to be looking at OmniFlex short-term care, namely. We talk about the short-term care market, but mainly the star of the show today is going to be OmniFlex. We're going to show you how that compares to traditional long-term care and the hybrid plans, the long-term care and life combo plans. Okay. Now, I start every webinar this way, and I guess I have been for the last 2 years since the pandemic, and maybe people are tired of hearing about it, but, for our industry, for what we do, the pandemic couldn't have been a better, COVID couldn't have been a better thing for our industry. We know that facilities were a bad place to go. If you're receiving your care at home during the pandemic, during COVID, compared to being in a facility, you were 11 times more likely to die if you receive care in a facility. People were terrified of going to nursing homes, assisted living, because that's where all the people were dying. 90% of the deaths were happening at the nursing homes. So people over the pandemic, more than ever, were very aware of long-term care. 90% of married couples are going to require some care. We know this, but 90% of adults have never had a discussion about it. And 61% of people surveyed said they'd rather die than go to a nursing home. Frankly speaking, the consumers have been more aware and more worried about the needing care than in my 26 years I've ever seen. Our websites, we have our lead seeking websites. We get more people requesting information about long-term care than we ever have. So, the long-term care days, the boom was, people say it's gone. I'll tell you what, it's coming back. Problem is the products that we're offering are shifting a little bit, and I'll talk about that. But just so everyone knows, if you ever thought you're gonna maybe do some marketing, maybe put a mailer out, maybe talk to your clients, suggest, what are you doing for your extended care? What have you done for your long or short-term care? You'll never have a more receptive audience than right now, largely because of COVID, and just because people are more worried about this than ever. So I would argue, just go ahead and bring it up. We'll help you with that, how to suggest it, prospect, that kind of stuff. But don't be afraid to bring up this topic right now, because it is a hot button for consumers. They don't want to go to a facility. They want to age in place. They want to stay at home. Okay, and that's what these plans kind of, it's the whole premise of short and long-term care. All right, shifting market. So if you've been in the game for a while, the long-term care market, it's shifting, it's changing. 10 short years ago, we had over 80 companies offering long-term care, traditional long-term care. And the prices weren't too terrible. But then we started seeing some growing pains, these carriers, rate increases. A lot of the carriers that were in it for a long time, the original, the John Hancocks, the Genworths, and they had all kinds of problems with people hitting claims. The numbers were off. The persistency was higher than they thought. Interest rates took a dive. Long-term care companies got out of this market. And I always tell my clients, I tell my brokers, insurance companies don't get out of markets they're making money in. Long-term care companies, if they're making a ton of money in this product, you'd have 80 companies still in this market marketing. We're down to 3 that are still doing it: Mutual of Omaha, National Guardian Life, and Thrivent. Okay, there's a couple other, Life Secure, you can do some group stuff. There's some bit players here and there, but generally speaking, you got 3 companies left. And all those companies are here to stay. They're committed to it. Of course, they've had to increase rates. They've had to charge more for females. They've had to tighten down underwriting. And all of this has really put it's pretty hard to get a long-term care policy put in place. It's, number one, people can't afford it. Number 2, people can't qualify for it. And frankly, after today, I think you're going to see that that's okay. There's a whole lot of room for short-term care. Again, eye-opening to me. I kind of overlooked this for most of my career. And granted, these short-term care plans haven't run that long, but they really are. It's quite eye-opening. Frankly, the short-term care is growing so quickly. It's more or less that recovery care, they called it, extended care. It's that stuff that happens after a hospital stay, a stroke, or what have you. Long-term care is more of that in-depth underwriting, and it's a bigger cycle. Maybe you have a couple that's in their early 50s that have plenty of money and they're healthy, and then we look at long-term care. But taking a look at short-term care is just something that we all have to address now, because this market is shifting and it's going towards the short-term care. That's, in my opinion, that's where a bulk of people are going to start being written now over the next 5-10 years. Is going to be short-term care plans. All right, and why can short-term care save this industry? Just a lot of things that are just common problems. The long-term care plans, minimum of 2 years. A lot of people are buying the 3-year, 4-year benefit. Okay, the inflation that are on these plans greatly exposes that risk to the carrier. Okay, with short-term care, you have a 1-year benefit. Okay, caps that risk for the carrier. You have limited benefit periods. Again, it's not as hard on the carrier. The catastrophic claims you have with long-term care, the old unlimited policies we wrote, that people ended up with Alzheimer's and they're on claim for 10 years or more. I think I just read Genworth's biggest ongoing claim has now eclipsed $2 million. That's one person, one claim. An Alzheimer's claim that's been paying out for 15 years or something. So those kind of catastrophic claims are not a problem for the short-term care companies. So with long-term care, you have much more stringent underwriting. Short-term care, not so much. Long, just arduous apps with long-term care. Short-term care, very quick apps. Also, there's no certifications with short-term care. There's with long-term care, you have to have the 8-hour partnership certification. You have to be recertified every 2 years. So just everything considered, much simpler, easier product to write, easier to get issued, cheaper, not as hard on the companies, so we don't have to worry about rate increases, because again, these are all capped benefits. If you know anything about rate increase, it's the older blocks that were written 10, 15 years ago that have the unlimited benefits and a lot of the 5% compound in them. So, the industry, the companies have gotten smart about how to protect themselves. So really, the short-term care is going to allow us to go back to the future and start helping a lot of people that need and want long-term care that we probably couldn't with long-term care. All right. So, and I said this at the beginning, it's time for all of us to abandon this notion that somehow short-term care is only an alternate for people who maybe can't, health-wise can't get anything else. Okay. I myself, all of us need to reprogram our brains to think this might be one of the first products I offer. I'm not going to lead with long-term care. If they can't get it, come back with short-term care. I'm going to make sure that they know what the short-term care thing's about, because people do like to pay a little lower premiums and have just as strong benefits. Matter of fact, you're going to see, in my opinion, stronger benefits in many situations. Okay, so cute little graphic my team put together here for me, but I really do feel like short-term care deserves that seat at the big boys table. It should be mentioned in with long-term care and the life and LTC hybrids. Okay, and there are a lot of options. Okay, Manhattan Life's the newest one that we helped Manhattan Life put together. That's kind of the lead dog, if you will. But GTL short-term care has been great. That's been around forever. That's the recovery cash, and then Aetna has a recovery care. Wellaby now has a nice short-term care plan out with some unique features. But just to keep in mind, like I mentioned earlier, GoldenCare has plans no matter what you bring us. Whether, again, if it's someone with osteoporosis or someone with, health problems, they've had a stroke, they've had cancer, we can find a product that will help these people out. Okay. Product availability quick, just so you can see, there's a lot of states here where we have product. The gray areas, always tough: California, Florida, New York, Minnesota, Oregon. But we do have True Freedom and other things available. We also have a guaranteed issue term life product that has a long-term care component to it. So if you're in one of those gray states, have clients in those gray states, again, don't be afraid to call us. We'll find products for you. Okay. And this, by the way, this copy of this presentation will come to you, so don't worry about the product availability. This is OmniFlex, the one I'm going to feature today, where it's available now. Virginia just got added. Well, it looks here at 2/11. So what was that? Sunday? Saturday? Yeah. Just this week, Virginia has been released. We've already gotten 6 apps from Virginia, matter of fact. So we're looking to really push a lot in Virginia there. Okay. So OmniFlex. Flexible, comprehensive, and robust benefits. I'll cover this. There is a built-in restoration of benefits. Now, I'm going to pause there for that, because a lot of people in the long-term care industry, especially the veterans have been around for a while, we kind of know that restoration benefits doesn't happen all that often. How often does someone exhaust their benefit, go to a nursing home for 2 years? And, well, that's because for a long-term care claim to happen, there's what's called that 90-day certification period. Now, there's 2 ways to trigger a long-term care plan. You either have to be cognitively impaired, or you're unable to perform 2 out of 6 activities of daily living. Now, a doctor has to say that this 2 out of 6 ADL deficiency is going to last, in their opinion, a period beyond 90 days. They've had a stroke, it's going to be 6 months or more. Okay, well, things like a hip replacement, a knee replacement. How often do we have clients that call us because they, broke their hip or whatever, and they're not going to need care for more than 90 days, so it doesn't trigger that benefit. Short-term care does. There is no 90-day certification period. Someone breaks a hip, they're qualified tomorrow, and they get paid an all-cash benefit tomorrow. So they may only need care for 2 months. Well, great. You know what? The benefit's going to restore again, back to full. Okay, up to 2 times your life maximum. So it's very important. Someone could have a broken hip, later have a knee replaced, have a heart attack, and then 4 or 5 years later have a stroke and then use a bulk of the coverage. So there are multiple situations where restoration of benefits will come into play with short-term care. With long-term care, it's more of a long shot. So don't overlook that restoration. Okay, this product has a built-in Fast 50. It's a cash benefit to pay directly to family and friends. No questions asked. Half the benefit get paid that way. Very affordable premiums. Simple plans, like I mentioned, easy to understand, easy to underwrite, fast claims process, and issue age is up to 89. So, and these things, again, they're more robust than you might realize. No, I just covered this slide. I apologize. This is a very important thing to understand with short-term care, right? This 90-day certification period is not in short-term care. So again, all these things: knee replacement, cardiac arrest, heart valve replacement, bypass surgery, hip replacement, motor vehicle accident. These things are covered with short-term care. And with OmniFlex, it's an indemnity benefit, so they're getting, the full either $9,000 a month or $12,000 a month for those first 2 months. What a great way to recoup those premium dollars you paid in. It gives you so much more. It's so much easier to claim on a short-term care plan, okay? And all these things I'm showing you. So that's why that restoration of benefits becomes so big, because it's very doable that you're going to have some small little claims here until maybe you have the big one. Okay, rates. Just a second. This is just look at the middle one here. So $200 a day, $6,000 a month benefit for the 12 months. For a 60-year-old, $71. I mean, they can get $12,000 a month for a facility, and then an additional $9,000 a month for 1 year of home care. So what they're showing you here is a 1 year, $12,400 a day, $12,000 a month benefit for 1 year. And also, if they exhaust the nursing home, they also have access to $109,000 or $9,000 a month for 12 months. So they're basically getting $144,000 and $109,000, $250,000 worth of coverage, all indemnity, for $129 for a 60-year-old. Now you try to do that with long-term care, you're talking about $300 a month or north of that. So the rates are very, very competitive, very affordable. Even if they want to buy $3,000 a month, look, a 65-year-old can get it for $55. Okay, there's a prescription drug reimbursement in there too, but come back to that. Okay, so this is kind of a little bit. There's a lot going on this slide, but let me just kind of tell you what I'm trying to show you here is that these policies can pack a punch. So, like I mentioned here, this person has a facility benefit of $400 a day. That's $12,000 a month. It's a 1 year payout. So that's $144,000 this thing pays out over a course of a year. Now remember, it has restoration of benefits. I doubt someone's going to get paid the full $144 twice, but in theory here, it's $288,000 total. And if they did the home care, right, the home care benefit here is $300 a day. You could get up to $300, which is $9,000 a month, and that pays $108,000 total. So again, without inflation, you got $144,000 for facility, you got $108,000 for home care. Okay, and that also restores. So you got two separate pots there, up to $216. So again, you add all that together, you know, it's got, you know, with inflation, without inflation, you got $252,000. With restoration, you've got $504. Now they're going to continue to show this if we throw inflation in there. Again, a lot of numbers here, but let's just say 20 years of inflation, you know, the benefits double. So look at this, you can actually get a total of $1 million. Okay. So this notion that you can't get a very big benefit with short-term care, throw that out the window. You can get a lot of benefit here. And I'm going to show you later that, you know, a $250,000 is a lot of coverage. It's going to take care of 70% or more of most cases. Okay. And by the way, a premium for this, for a 55-year-old person in Iowa, the premium for that is $90.98. That's without inflation. With inflation, it's $163. So again, going back to that, a 55-year-old can get $250,000 of coverage for $90, and it's easier to access. Okay, okay, the next slide. So at GoldenCare, we write a good bit of business. The next slide is going to show you a little snapshot of that, but this is just another slide I took out of one of my colleagues' presentations. If you look at the thing, 3 years on top there, any type of services, meaning home care, you know, typically people start at home when they get their claims. Maybe again, it's a stroke where the mom's helping out. Maybe the kids come in and rally around, try to keep dad at home for a while. Eventually, you know, he needs facility care. And so in other words, any services average is about 3 years. 70% of that, 70% of people are going to be at that 3 year or less. At home, about 1 year, that's 59% of people. Any type of care over a period of 2 years, that's 65, 2/3 of people. And then nursing facility, again, 35% or 1 year. Any type of facilities, 37%. In a nutshell, that top stat tells you that 70% of people aren't going to need beyond 3 years of care. And the benefits that we're selling now in this industry really reflect that. Where sure, people are going to sometimes need 5 years of care, 6 years of care. It happens, but we're not really selling policies anymore that cover it. Look at our numbers here. This is from $30 million of long-term care premium written over the last 3 years by GoldenCare and our sister office AIM. So this is a small snapshot, but it's a decent amount of long-term care to be talking numbers here. So this is what our average is out of our agents that sell this $30 million of premium. 65.5 of those policies sold have a max benefit between 2 and 3.5 years. Only 15.4 policies have max benefits greater than 5 years. So what I'm trying to show you here is, the average premium in that per person, $2,804. So again, 2/3 of people, 2/3 of the policies we're selling are 2 and 3 year benefits. Now, if that's the case, if 2 to 3 times we're only offering this 2 to 3, because normally look at that premium, $2,800. It's hard to really give them a 5-year benefit and a $6,000 premium. Again, if they're young, healthy, in their 50s, we do still. They have plenty of money. They want to buy. Long-term care is always going to be a part of this equation. Okay, but a bulk of what we're selling. So 2/3 of the time, I'm about to show you, 2/3 of the time that we sold this long-term care policy, I feel like we did them a disservice by not selling them short-term care. This is the way it's packaged. It's just much easier to get to, entertain, cheaper, easier to access, restoration, cash, everything. So if 2/3 of us are selling to 2 to 3 year plans anyways, then maybe we got to start looking how short-term care can fill that void or foot the bill there. Most of our clients over age 65, if people waited till they're 65, 68 to buy a long-term care policy, those people aren't buying much more than 2 years of benefit. They're going, the minimum you can get. I'll quote $4,000 a month, $100,000 pot of money, because that's all they can afford. And for someone who's 68, that might be $5,000, especially if you put inflation there. So, and then you see some of these 68-year-olds decide not to get long-term care. What a shame. They should get something. Okay. If you've ended any of my webinars in the past, I'm a big believer when designing long-term care. So really, I should have seen the light on short-term care long ago. I've always been a huge proponent of shorter and fatter being better than a long and skinny. When agents call us here, they'll ask us for a quote, and they'll do like this quote on the far left, the long skinny. They'll say, yeah, give me a 5-year benefit. I want a $4,500 a month monthly benefit. And if you look at that, a 5-year benefit, $4,500 a month, 100,000 assisted living, 5% compound. This is most of what we wrote, 10 years ago, and back 10 years ago and 20 years ago, that's what everyone quoted this. The big, a 5-year benefit or more, 5% compound. And these policies got rate increases, but this is a $4,500 for 5 years. Look at the policy maximum in black there. Okay, that's okay. $4,500 for 5 years, that equals $270,000. Now, I've been teaching people for years. Look at the premium in that, $11,488. What you have is a long, skinny policy. This thing's going to be bled over a 5-year period. Wouldn't you rather get all your money that you paid in over a quicker period? So how about let's do $7,500 a month benefit for a 3-year period. I'm not taking anything away from that client. It's still $270,000. They just access it quicker. And for that, I'm going to drop the inflation to 3%. Because 3% of $750 per month is the same thing as 5% of $450 a month. Now, eventually these cross over, and I'll show you that down here, but look at the premium when I go short and fat. I just shaved, $3,000 off that premium. Okay, that's a stronger policy. Let's take it a step further. I'm going to condense it down as much as I can. I'm going to go with a $10,000 a month benefit. I'm going to squeeze it over a 2-year period. I can drop the assisted living 50% because I'm still at $5,000 a month for that. Number over here, I was only at $4,500. So I'm still giving them more benefit. And then I went with 1% inflation. As I moved it up to 10,000, my policy max, still $270. All 3 examples, $270. Look at the premium. Now, if I was talking to a client, I would tell them, take short and fat, 2.0, over long and skinny. Why? Just as strong a policy, and I'd argue stronger over the first 10, 20 years, half the price. Okay, so look at here. Now, this is for a 60-year-old couple. So average claims happen at 81, 82. So let's just claim at 85. Look at here. So there's more benefit now. There's more. It's 10,000 now versus 4,500. 11,000 in 10 years versus 7,000. 12,000 versus but nets out year 22. So again, if they live to be, 87, they could lose all of it. But you don't have to go. You can actually put maybe a 2.7 year here or 2. You don't have to necessarily go all the way down. This is just for example. But the best way to sell this, and always has been, is a shorter, fatter policy. Important that you understand this concept, okay? Because what we're doing with short-term care is we're simply taking a shorter and even fatter approach, all right? So this is the old model I've taught for years. And if you're doing long-term care, I want you to sell this yellow one. That's how you should be designing plans. And now I have short-term care. Look what I can do here. Remember, this is a pot of money of $270,000. So here, same 60-year-old couple, I'm going to take a $12,000 a month benefit over a 1-year period. 5% inflation, simple, that's what they have in this one, 100%. So the premium here now, $39.57. I'm crushing it, right? And my benefit now, It's $12,000 for facility, $9,000 for home, and you can use both. In 15 years, $18,000. In 25 years, $24,000. I'm killing this, right? Why would I make my people, my claimants, have to wait to be paid over a 3-year period? They might die in year 1. Let's give them the premium dollars they paid in back, access to it quicker. I mean, ideally, we just give it to them all the first day, right? Well, insurance companies don't want to do that, right? They want to bleed it over a long time so they don't have to pay the claims. That's how it works. That's why it's probably surprising to me that the long-term care companies have to charge as much as they do, but it's because of those catastrophic claims. They have to charge more for even the small. It's just the way it all works out. So kind of abandon the notion of long-term care. Look what we can do with a short-term care plan. We're killing it, right? For a lot less premium. All right, so let's compare these things. Is this really, again, very eye-opening to me? What time do we got here? 2:26, right? I said 35 minutes. All right. I'm gonna try to take these numbers kind of slow. I feel like I'm throwing a lot at you. I apologize. I'm getting a little excited with it, but when I do look at these, it's so eye-opening. Okay, so I'm just gonna compare a couple plans here. This is for a 60-year-old female. On the OmniFlex short-term care plan, I'm gonna do a $12,000 a month benefit. That's $400 a day, $12,000 a month. That I'm gonna max out the home care. That's $9,000 a month. Now on traditional long-term care, I'm gonna do $4,000 a month for a 3-year period, because $12,000 for 1 year is the same as $4,000 for 3 years. They're both going to give you $144,000. But the good news with short-term care is we're going to throw in $108,000 of home health care for free. It's just going to be part of the plan. Great. So I have $252,000 with the restoration in there versus $144,000. Same 90-day facility, 0 in the home care, with the home care waiver in the long-term care. In this example, to make it easier, there's no inflation. Annual premium, $1,410 versus $1,906. The OmniFlex has a built-in there's a reimbursement for any prescription drugs. If the person's taken more than 1 or 2 meds, they're getting $300 back. So $1,100 versus $1,900. And again, I'd argue the OmniFlex all day long, as long as we're writing small plans, which I just showed you, most of the time we are, then we have to be looking at OmniFlex. You really owe it to your client. Okay, so come claim time. Another way to say, I kind of beat this a lot of different ways, so I'm just hoping I'm getting my point across, but come claim time, just ask your client, would you rather receive $144,000 over the course of 1 year, like $12,000 a month for 1 year, or would you rather receive $48,000 a year over the course of 3 years? In other words, $4K a month for 3 years. You're gonna get your $144,000 either way. Who in their right mind wouldn't want to take all of it up front? You don't know how long you're going to live on claim. You want to get that money back. Unused amounts go to your bank account. It goes back in your client's pocket. So you give me an argument for why you want to have it bled over 3 years. Doesn't make any sense. All right, let's stack it all up in front, short and fat. Okay, let me give you a couple claims examples, and I'm going to show you how this compares to a hybrid as well. All right, so this is just an example. A lady has a stroke. 15-month facility claim, then she dies. All right. So maybe how about this? How about let's not make her die. She goes to the facility for 15 months, then she comes home, recovers, whatnot. Okay. So in that 15-month claim, OmniFlex pays her 140. Remember, 90-day elimination period. So this paid in the 4th month. So over those 115 months, she received $144,000. Traditional long-term care only paid out $48,000. What's left? Remember, it restores. So now she has $144,000 available to her again, where the traditional long-term care only has $96,000. Both had a 90-day wait to get the benefits, right? So remember the premiums, $1,100 versus $1,906. Who's better off come claim time in this one, right? For certainly be the short-term care. Another one, here's a hip fracture, 6-month claim at home, receiving care. Okay, so this is first day cash benefit to pay for informal care. If you know the traditional Mutual of Omaha is what I'm using here, that's a 25% cash benefit. So they get 25% of that $4,000 a month or $1,000 over a period of 6 months. They'd been paid $6,000 cash for that family member who's taking care of them. With OmniFlex's Fast 50, we can get half of the $9,000, which is $4,500, paid directly to the insured, no questions asked. So they can pay that family member $4,500 a month, not just $1,000 a month. And after 6 months of that hip fracture, OmniFlex would have paid a family member theirs $27,000 versus traditional only 6,000. Okay, remember premiums 1,100 versus 1,900. Again, which plan would you have come claim time in this one? Third one, hip fracture, 6-month RN visiting 3 times a week. So that's, remember, the last example was just using the cash, right? This is just family members are helping out here. But in this example, it was a fracture where we needed an RN out there 3 times a week. Maybe they're single, there isn't a spouse, there isn't a availability of a loved one to help out. So they have an RN visiting 3 times a week. All right. With OmniFlex, that would have paid out $21,000. With a traditional long-term care, it paid out $10,800 or less. Okay, because it depends on what they bill. We're saying $150 a visit here. If that nurse maybe was a basic nurse, only charged $110 or something, well, that's reimbursed at $110 then. So it doesn't quite pay out the whole amount. Remember, with OmniFlex is a full indemnity benefit. It pays out the whole amount no matter what care happens. That nurse comes through that door, you get the whole amount, no matter what. You signed up for $9,000 a month or $300 a day. She comes out and bills $125. You're getting $300. That's just how it is. So again, in this example here with an RN coming out, it would have paid out twice as much. Again, $1,100 versus $1,900. All right. So again, I did the same example here, but this time I threw inflation in there. And so again, this is a 60-year-old female. Now here, I'm going to try to match that $252,000. So I wasn't being very fair to OmniFlex because I wasn't including another $109,000 of home care benefit. So this example, I'm going to do a straight comparison. So this is going to be a $6,000 a month, total of 3.5 years here. That's how I arrive at $252,000. I have to do a $6,000 a month benefit for 3.5 years. That gives me a pot of money of $252,000. Remember, over here on the other side, this is a 1-year, $12,000 a month with the $108,000 home care, $252,000 with restoration, so it's still stronger, right? Even if you never use it, okay, they're even, $252,000. Okay, and on the OmniFlex, I'm going to go with a first day facility and first day home care. I'm going to be nice to the traditional long-term care. I'm going to give them a 90-day facility with a home health care waiver, right? Now, the inflation, I'm going to do 5% simple. The traditional long-term care doesn't have 5% simple, but if you know the inflation is 3% compound and 5% simple, really kind of equal each other out there. The 3% will pass eventually, but it's not for like year 29, 30. So again, for the 60-year-old, for the sake of argument, it's as close as I can get them. Look at the premium, 29 versus 71, $2,936 as opposed to $7,100. If I'm talking to a 60-year-old, I have a much better chance, especially if they're premium sensitive, right, which is about 3/4 of people, then I'm going to lay that 2636 in front of them. But if I lay that 7154 in front of them, chances are I'm not going to sell that. With the short-term care, I can. Okay, so it really, for most of what we're doing in this day and age with long-term care, we're just not selling 5-year benefits with 3% compound and $500 a day. We're just not selling that anymore. Okay, unless again you have those affluent people that can afford the $10,000 annual premium or $12,000, and they exist. And so I'm not trying to tell people not to write long-term care. I'm saying that 2/3 of the time, 70% of the time, short-term care would have been a better fit and a better product and a better price, and overall it would have been a much better experience for that client. But for the other ones, yes, we're going to still use long-term care. This is why we always want our clients to our agents bring us what you're working on. We'll give you that advice. Okay. Here what I did, same thing here. I just, it's like I put the inflation in there. And no, this is a married couple. Yep. So married couple, again, you want to spend $9,500? You want to spend $4,900 for, again, a much stronger policy on the OmniFlex. Okay. Do a couple comparisons, hybrid. I'm going to open up to questions. Just real quick. You've seen me do these before. There's a lot of numbers running here, so I don't want to. What I did here, and I do this a lot when I talk about hybrids. Okay. Nationwide Care Matters 2 is one of the hot products out there. It's a great product. It pays all cash. It really is. It's kind of the cat's meow out there now. It's really competing with One America's plan quite well. It does deal with a second to die policy. It's got an all cash benefit, much like the Security and Life or some of the other hybrids out there. So I am a big fan of cash, because as we know, family members are involved in the care 70% of the time. We really have to have a cash component, in my opinion, to have a complete long-term, short-term care plan. If you're not able to pay family members, it's just not that good of a policy, right? It's really, If there are policies that will pay cash for the same price, you got to sell the cash ones because family members are the ones that are doing that care. Why not pay them? Okay, so in this example, I'm going to write, okay, this up here, it's a $250,000 total long-term care benefit, right? And then I have a $250,000 death benefit. So you know how hybrids work. You know, if you die in your sleep and never use a long-term care, you get $250,000 death benefit. But if you use a long-term care, use up most of that, you get the remainder as a death benefit. Now, again, Nationwide is nice. They have a residual in there no matter what happens. I think they give you like 25,000 or, okay. So what I'm going to do here is I'm going to take the same benefit. I'm going to do a $250,000 OmniFlex benefit. And that premium was $29.36. Then I'm going to do a $250,000 death benefit. Just separate them. I use Columbus Life for this. It's an IUL. That premium was 40. So look here, it's 72 versus 95. And the nice thing is that when they go on claim time, oh, that's another example. I have that down here. Yes. Okay. So the 95 and the 721. So come claim time, the monthly short-term care, this must be inflation one. Okay, so here I went ahead and put the 3% compound in there. The death benefit on this one, by the way, is $150K. And the total long-term care benefit is $250. So the premium here again, $95.27. The OmniFlex with the Columbus Life, $56.53. Okay, so come claim time, what does it look like? So remember, for $7,271 versus $95.27, the monthly short-term care benefit with a Nationwide is $14,230. With OmniFlex is $24,000. Okay, I'm still going to pay out $250,000 no matter what. Now, if with the Nationwide, if you use up your long-term care benefit, you don't get the death benefit anymore, right? There's a guaranteed minimum in this example of $33,600. So if you had a long-term care claim, you don't get paid the $250,000. In the example below, for a lot less premium, I can give them a lot more, $24,000 a month, which again, 30 years from now, you might need that for the care industry. So they can have a $504,000 long-term care claim. When they die, we're still going to give them $250,000, right? So separating those plans to begin with is kind of a better move. Harder to do. I know clients don't like it, but I can take an OmniFlex and just buy a separate, some type of a IUL. Doesn't matter what carrier you use here, but that way I don't give them either or. For less premium, I give them both benefits. Why would I give someone half a benefit for a lot more premium, right? So there's ways to compete when these things, even on the hybrids. This thing's a little more advanced. I'll give you a copy of this, but I got another example with kind of the same type of thing. This one I just used a married couple. Premium there again for them is $13,700 versus $8,900. Okay, by again separating, putting a short-term care plan. This one, this example, I used a second to die life. That premium was $34,000, so they're going to get the $250,000 death benefit no matter what happens to them. The married couple, they're getting $250 back no matter what if they have a long-term care claim or not. Look at that, it's $5,000 less. Why would I punish my clients with an either-or situation? I give them both benefits and a easier to access benefit, a cash benefit. Nationwide again has a cash benefit, so that's pretty good benefit in that respect. So, you know, I guess the point I'm making here, and I'll wrap it up with this. I appreciate you giving me the 40 minutes. OmniFlex short-term care needs to be part of this conversation. If you have cases, you have clients you want to talk to us about, I urge you to give us a call. Again, 800-842-7799, or go to our website, goldencareagent.com. The short-term care thing is here to stay, and honestly, it's being overlooked, and we can make some great arguments for it. Not always going to be the case, but I'm starting to think that about 2 out of 3 times, your clients are much better off with short-term care. And it's time to reprogram, my brain included, because I've written way too many long-term cares that I wish there were short-term care plans in place for a lot of them, for the ease of claim and everything else. So let me see, we got questions here. We probably got a lot. Let me expand these out. We still have 30 of you on here. That's great. Thank you for staying on. Let me pop these out. Okay. All right, someone wants us to show us how to do the illustrations. Ray, I would say this, on our website, we did webinars where we actually have recording of where you go to Manhattan Life's software. I can do that quick for those of you who aren't on leave. I can bring up a thing and show you how to do a quote. Please fully exchange restoration of benefits. Well, again, it restores your benefit. It's up to 2 times lifelong maximum. So if you have a $200,000 If you have a $144,000 long-term care benefit and you exhaust that, you're in a nursing home for 15 months and you recover, you go back home. After 6 months, that benefit restores to full. So you're ready to claim again. You can't be in claim for the same stroke, like you never got better from it. But 6 months home, it restores your benefits to full. And so where that probably doesn't happen, people don't use a whole full year of benefit and then recover. I'll give you that. But on these hip replacements, knee replacements, all that kind of stuff, you had that 144,000 until that's exhausted. You can actually use 144,000 twice. So I mean, it would take you 6, 7 claims at 3 months here, 3 months there, but that is possible. Okay, and there are a lot of people do have the hips, knee fractures, hip fractures. All right. So that's the restoration. And Rich, if you want to call here, we can kind of go through more of that. So short-term care, I got another question here saying short-term care is a 2-year max because it's got a 1 year at home and 1 year facility. That's true, but it's not. If you're at care at home and you're getting care twice a week, it might take you 3 years to exhaust that home care benefit. It's not a monthly payout, it's a daily indemnity. So people that are getting care twice a week at home, that benefit's gonna last for 3 years. And maybe they are getting benefits at home for 2 years and they get better from that stroke or that accident or what have you. They could actually restore that to another 109,000. That could be reused, probably less likely, but no, a short-term care plan, you could be in a facility for 9 months and then be at home getting care. Let's do it the other way around. You had that stroke, mom's trying to help out. You're at care, you're getting care at home for about 2 years, 2.5 years. And then eventually it got to be too much for mom to take care of dad. We then had to go to a facility. That's a 3.5 year claim. So with short-term care, again, that's what we're kind of talking about. We have to get it out of our head that at 365 days, this stops paying. No, it's an indemnity plan. Each day that you need care, you get indemnified for. Now in a facility, naturally in 12 months, it's gonna run out of benefits because you're there every day. But in home care, we all know it's usually 1 day a week, 2 days a week. So there's numerous ways to do that. So this can be easily a 2, 3 or more year benefit, which is my whole point of, if that's gonna wipe out 75% of most claims, then we have to look at this. What else we got here? It's a lot of them, oh boy. Premiums do not go up on age. So every year you get older, it's not age banded like home health care plans. They go up every 5-year age bands. All right, there's another question. Now let's see, are we getting any pushback from, okay, why is short-term care less expensive than long-term care, especially when long-term care policies have elimination periods and more stringent underwriting requirements? Is it due to the shorter benefit periods? If so, isn't that evidence of a 1 year? So I think I know what we're trying to go with here, John, and I kind of understand what you're saying, but no, I think it's because of catastrophic claims that happen. Every 10th claim ends up being these $200,000 claims, or every 20th that blow all the numbers for long-term care. They have to be prepared to insure someone for a decade at, who knows, if they put 5% compound in that thing or 4% compound at a $6,000 a month benefit. Let me get this to voicemail. Then at that point, that's the catastrophic claims. So with short-term care, they know it's a 1 year payout. They know how the inflation is capped, amount's capped, the dollar amount's capped. It's a certain amount. We're not expecting any rate increase with these things because it's all set. The whole variable of long-term care, especially in the unlimited claims back in the day. So why is it less expensive? It just is. There's just less risk there for the carrier. I kind of point that out in the first couple slides. But no, long-term care, and it is baffling when you look at the numbers, because I just totally didn't see it. And I'll be the first to admit it. I've eat, breathed, and slept long-term care for 20 years, and short-term care has been around for 10. I just missed this. I really did. And I'm really starting to turn when I talk to people and I quote things and agents bring me cases. I'm like, this is a better fit for short-term care. And I'm a big believer in that. Okay. Here's another one. No, this is an indemnity plan, like I mentioned earlier. It's not reimbursement, the short-term care is. Can small businesses pay for the business owner and be a legitimate business expense? Jeff, that's a good question. I'm not sure if it's filed in such a way. You know, C corps, S corps, limited liability corporations can, as long as someone's a 2% owner, they can buy that for people and themselves, and it's a business expense. I just don't know for sure. I can get you the tax guide on that. I'm not sure how the address. I just don't want to answer wrong, Jeff. So, is it legitimate? Does short-term care count in the long-term care? I'll have to look at that one, Jeff. I'll get back to you on that. I want to say no, but I could be wrong. Like, it could be a legitimate business expense that you can put under, your same, lump it in with your other healthcare expenses. Okay. Here's another one. Here's an example. Is there any situation where long-term care beats OmniFlex? Yes, of course. If you got people that are young, healthy, they can afford the premiums. If you're buying a benefit of, say, 5 years or more, you want that $500,000 pot of money, you want it growing at 4%, well, then that pot's going to grow to $2 million. We can't compete in that lane. Those premiums are 20 grand, but we do have a handful of people, financial planners, people that fund long-term care with like a life or an annuity contract. So we see some of these mega premiums for 17, 18,000, and no, OmniFlex can't compete with that. Like I mentioned earlier, it's really going to compete with a lot of the small long-term care plans that are writing. And so the biggest thing I want to take away is, three-quarters of the time that you're running a long-term care benefit, unless you're writing the behemoth, the big one, then you probably should be looking at short-term care. So no, there are a lot of situations. I'm just not sure that I would write long-term care for a lot of the clients that I'm quoting. The people that are spending $2,000, $3,000 a year, they're better served in short-term care. All right, and that's all. I think that's all I have here. It looks like there's, again, much more benefit for less premium. Why are short-term care companies less financially stable? All right, well, it's just because they have a capped risk. The long-term care has a catastrophic claims. Those things can pay out for years and years. Okay. All right. I can get you a copy of this. I want to thank you guys for coming on. Great questions. Great crowd. Looks like I've only lost a couple of you. So just want to thank you again sincerely for spending the time for us. If I've covered anything too quickly or kind of, we'll get you a copy of this. My biggest suggestion would be, please call us. If you're working on a case you had to quote or a client you want to kick it around with us, don't want to come off as saying short-term care has replaced long-term care. I just think it needs to be part of the argument. It probably should be something you're looking at for, again, 2/3 of your clients. It's probably a better solution, more affordable, et cetera. Less chances of rate increases, et cetera, et cetera. I want to thank you guys for coming on board. Again, 800-842-7799 is our number if you have a case, something you're working on. Otherwise, please visit our website, goldencareagent.com. There are pre-recordings to a lot of the questions that are on there. Tom Randall that has some great ones about risk assessment, carrier, catastrophic, some of the questions we're talking about there. So I urge you to log on there to get all the help you can get, pre-recordings or other tools, products, things we've got available to you. Other than that, I want to just give you a big thank you for coming on board today. Please call us. Let us help you write more of this short-term care, long-term care, home health care only. No matter what you're working on, GoldenCare's got a solution for you, no matter what part of the country you're in. So again, thanks for coming on board, and we'll be in touch.
GoldenCare is always here to serve you with new tools, new products, new ideas, and new innovations, and always the best support in the business to help you succeed. So give us a call at 800-842-7799 and check out our website at www.goldencareagent.com.